The financial statements of a business communicate how the business is going. The first statement that we prepare is called the Statement of Comprehensive Income. This is also known as the income statement. The income statement is very important because it shows you the net profit of the business. The net profit is how much the business has earned during the period of time. This shows the performance of the business. On the income statement, we have two different things. We have the revenues, and we also have the expenses. Here is the format for the income statement. The first thing we do is we start with the heading. The heading has three things. It has who. What is the name of the company? What? Which statement is this? And then it has when. What is the date for this statement? For the income statement, the date has to be written specifically like this. It shows the period of time that this is for the year ended, and it shows the last day of the year is the 30th of June 2020. On the income statement, we can see the revenues and the expenses, and they go in this order. So first we start with the sales revenue. This is what the business has earned by selling their products to their customers. Then we minus the cost of sales. Cost of sales is an expense for the business. Cost of sales is how much it cost the business to buy the products that they have sold. For example, they might buy the chocolates for $10 each and sell them to the customer for $30. The gross profit is then calculated. It's your sales revenue minus the cost of sales. So in this example, the gross profit would be $20. After the gross profit, we have other items of revenues and expenses. So first of all, if the question has any other income, this could be interest revenue, other revenue, rent revenue, any other income, then you will add it directly after the gross profit. Then we list all the operating expenses. We've already had one expense. This is cost of sales. Operating expenses is where we put all of the other expenses. Expenses are the costs of running your business. Here are a few examples: rent, interest, salary. You could also have utilities, supplies, electricity, depreciation. Every question will be different. Each expense gets listed one after the other under the operating expenses. And then you calculate the profit before tax. The profit before tax is your gross profit plus your other income, and you minus all those expenses, and that equals to your profit before tax. Right at the end, we have one more expense called the income tax expense. This expense is calculated based on how much profit you have earned. If your profit is $100 and your income tax rate is 30%, your tax would be 30% times 100, which is $30. So your net profit could also be called your profit after tax, is your profit before tax minus your income tax expense. And this net profit shows the performance of the business during this year. The income statement is the first statement that you calculate, and once you know the net profit, you can then calculate your retained earnings ending balance. Earnings is another word for profit. Retained means kept. So this is calculating all the profits that have been kept in the business. You start with your retained earnings beginning balance and you add the net profit that you have just calculated, and then you minus the dividends, which are the profits that have been distributed to your shareholders or owners. This is the second calculation. Once that's completed, you can then do your third calculation, which is your statement of financial position. The statement of financial position is also called the balance sheet. The balance sheet has three elements: the assets, the liabilities, and the equity. An important part of accounting is to understand what these mean and what is included in each part. Assets are things that the business buys to use to run the business, and they will bring a future benefit to the business. I summarize this by just saying these are things that the business owns and uses to run the business. Liabilities are things that the business owes. And equity is how much of the business the owner owns. It's called the balance sheet because the total for the assets should be equal to the total for the liabilities and the equity. So another way to describe equity, if you rearrange the equation, equity equals the assets minus the liabilities. On your balance sheet, you will list all the assets that the business owns. Here are some common assets, and there are many more. Then you list all of the liabilities. These are things that the business owes. If the business buys something but they didn't pay for it, this is called an accounts payable. Unearned revenue is also a liability. It's when the business has received money from the customers and they owe the service or product to the customers. A bank loan is also a liability. It's where you've borrowed money from the bank. Then we come to equity. In this subject, our equity is going to include two things. Equity will include two things. It will include the contributed capital. This is the money that has been invested by the owners into the business, and it will also include the retained earnings. This is the number that we calculated after we completed our income statement. That number for the retained earnings ending balance will be added here with equity, and this will make the whole balance sheet balance.